Welcome to the deep dive. Right, we've got this stack of sources you sent over on car loans in India.
Yeah, quite a bit of material here.
So we're going to jump in, sort of unpack it all. The mission today, basically give you a shortcut to understanding what's in here, help you navigate financing a car. I mean, it's a pretty big decision, right?
It absolutely is.
Yeah.
And based on this info, the core idea is, well, pretty simple on the surface. You borrow money, buy the car, pay it back over time with interest.
Okay.
What really jumps out, though, from these sources is just how common these loans are.
Yeah.
And the flexibility. We're talking 10 years up to 7, maybe even 8 years sometimes.
That flexibility sounds really key. And it looks like lenders often cover a big chunk of the cost, too.
That's right. The sources say often 85, maybe 90% of the on-road price.
Wow.
And sometimes, yeah, even up to 100% in certain situations.
Okay. So one of the first big things the material digs into is interest rates, fixed versus floating.
Exactly. This is like a fundamental choice you have to make.
So fixed rate, that means your monthly payment, the EMI, it just stays the same month after month. Predictable.
Precisely. You know exactly what's coming out of your account. Rock solid. Now, floating, that's different.
Right. That one can go up or down.
Based on market benchmarks. And the sources frame this as a trade-off. Fixed gives you stability, which is good if you think rates might go up.
But you might start a bit higher and you'd miss out if rates drop later.
Exactly. Whereas floating might start lower and you could benefit if rates fall. But there's that risk if rates climb, your EMI goes up too.
So it really comes down to your comfort level with, well, potential changes in your payment and maybe your guess about where interest rates are heading.
That's a good way to put it. Your risk appetite, essentially.
Okay, and talking about rates, what are they looking like right now? I see a June 2025 snapshot in here.
Yeah, the sources suggest it's pretty competitive out there. For new cars, they're mentioning starting rates, generally around 8.15%, going up to maybe 9.5% per year, and onwards from there.
And I saw some specific bank names mentioned too, just as examples, like Indian Overseas Bank around 8.15%, State Bank of India maybe 9.10%, HDFC at 9.4%.
Yes, those examples are in there. But it's really important, as the sources stress, these are starting rates. They can vary a lot based on your profile.
Right, right. And used car rates are usually higher. That's mentioned too.
Definitely higher for used cars. That's a consistent point.
Okay, so rates covered. What about eligibility? Who typically gets approved based on this material?
Well, the criteria seem pretty standard. You generally need to be an Indian resident. There's usually an age range, maybe 21 up to 60 or 65 by the time the loan finishes.
And income.
Yeah, minimum income levels are mentioned. For salaried people, something like ours, 2.4 lakhs a year minimum, maybe a bit lower for self-employed, like 1.8 to 2 lakhs, usually based on tax returns or financials.
Okay. And stability, like job stability or business stability.
Right, they look for that too. Usually wanting to see maybe 1 to 3 years of stability in your job or residence.
Got it. Now, here's something the sources really, really hammer home: your credit score.
Oh, absolutely. This is highlighted as critical, not just for getting approved, but for the terms you get.
So a good score, they mentioned maybe over 750 is preferred. That could mean better interest rates.
That's the strong implication, yes. A better score potentially unlocks better rates and terms. It really makes you stop and think, doesn't it? Do you actually know your score right now?
Good question. It feels like checking that and maybe improving it before you apply could make a real difference.
Very likely. And the documents needed are pretty standard stuff. KYC, like ID and address proof, income proof, bank statements, and then docs related to the car itself. Just underlines you need to get your paperwork sorted.
Okay, so what about after you have the loan? The sources talk about managing it, like prepayment and refinancing.
Right, so prepayment is basically paying extra towards your loan principal ahead of schedule.
Which can reduce the total interest you pay or maybe lower your future EMIs, yeah.
Exactly. And foreclosure is just paying the whole thing off early. Done. Car's fully yours.
But there can be catches, right? Charges.
Yes, you need to watch out for that. The sources mention potential prepayment charges, especially in the early months or maybe the first year. Could be a percentage of the amount you're paying early.
And lock-in periods, too, where
Yeah.
you just can't prepay for a while.
That's also mentioned, yeah.
Yeah.
Maybe the first 6 months or a year, potentially.
But there was a specific point about floating rate loans here.
Ah, yes. Good catch. According to the material, generally, floating rate car loans don't attract those prepayment penalties. That's tied to RBI guidelines mentioned in the sources. So that's a potential plus if you think you might want to pay it down faster.
Interesting. Okay, and refinancing, that's basically switching lenders.
Pretty much. You
Yeah.
take out a new loan, probably with a different bank or NBFC, to pay off your old one.
Why would you do that?
Well, the main reasons mentioned are trying to get a lower interest rate than your current one, maybe reduce your monthly EMI, or sometimes even get a bit of extra cash, like a top-up, based on the car's value.
Yep.
It's treated like a new loan application, though based on your credit worthiness then and the car's age and value.
Okay, so if we pull all this together from the sources, what are the key steps for someone listening?
First, really nail down your budget. Not just the car price, but the total loan cost. Then, research. Compare different lenders. Look beyond just the headline interest rate. Check all the fees, the penalties.
Definitely check that credit score, work on it if needed, understand every single charge.
And choose the loan tenure carefully. A longer tenure means lower EMIs, sure, but you'll pay more interest overall. Balance that out.
Look out for special offers too, like festive deals maybe.
Good point. And finally, repeated advice in the material. Read the fine print. Always. Before you sign anything.
So wrapping it up, what this deep dive suggests is that getting a car loan isn't just transactional. It's a major financial decision that needs you to be informed.
Absolutely. It impacts your finances for years.
Which brings us to a final thought, maybe something to mull over. Given how much total interest adds up over time, especially with longer tenures, does chasing the absolute rock bottom starting interest rate always match up with your long-term financial comfort and, well, peace of mind? Something to consider based on everything we've just discussed from these sources.
A very pertinent question. Well, thanks for bringing these materials for this deep dive. We really hope this breakdown helps you make smarter choices on your car buying journey.